Guys, I'm here in this video to tell you the truth about investing in growth companies. A very common theme that I see being discussed by a lot of investors is that, are you a growth investor or are you a value investor? And guys, I'm here to let you in on a little secret. There is no difference. Investing is investing. Every investment is the present value of all future cash flow. A fast growing company will have a higher present value of future cash flow because as a growth company, one that's growing faster than the normal economy, they will be generating more cash flow down the road. So as you bring that cash flow back, it will be a higher number. Now, don't get worried if that sounds confusing. I'm going to show you very shortly in a nice and easy to read Excel sheet. But it always bothers me that people say, growth investing is different than value, and I'll explain why in 2 seconds. But I also think it's because people want to justify these nosebleed valuations they give to high growth companies. This company is growing. This company is doing great. You got to pay a premium. I don't disagree. You absolutely have to pay a premium. But what do we think of when we think about value investing? We think about old dinosaurs like Warren Buffett and Charlie Munger and Ben Graham and all these guys sitting there and looking for companies that are selling below their book value because they got a lot of factories and land and assets, even though the business is dying. And that is a form of value investing. All growth investing is value investing when done properly. But not all value investing is into growth companies. And this really switched with me when I read the book, Common Stocks and Uncommon Profits by Philip Fisher. That really changed the way in which I looked at investing. And it changed the way in which Warren Buffett and Charlie Munger invested as well. They went from buying those Ben Graham asset-based businesses that you don't care if the business goes to zero because you have the assets to back it, to then banking on higher growth companies and paying a premium for that. Now, you need to watch this video in full because just hearing growth investing and value investing are the same thing isn't enough. You got to understand the true dynamics behind that. Now, let me show you in this easy Excel sheet I created. We have two companies here, Company A, Company B. Company A is going to grow their NOI, net operating income, by 4% a year. Company B by 15% a year. Clearly, Company B is the growth company. Okay, now, they both start by making $1 billion a year. Both companies, and you want a desired return of 10%, okay? So what that means is you're going to sit here and say, for the next 10 years, they're going to grow their NOI by this amount, and I want to make a 10% return on that growth. So what do I have to pay for that today? Well, Company A, $1 billion year one, $1.04 year two, 4% growth, on the way down the line, and in year 10, it makes $1.48 billion. You take the present value of all that. If you want to make a 10% return, this is a simple Excel function, $7.4 billion. Great. Company B, $1 billion, grows 15% a year, $1.15 billion, $1.322. In year 4, it already has a higher NOI than in year 10 of Company A. And in year 10, they have $4 billion in NOI. What's that net present value? $12.8 billion. So what this means, guys, is you can get a 10% return on both companies. It's just the price has to be different. You got to pay $7.4 billion here, and you got to pay $12.9 billion here. Same return, different price. Now, if you've heard me in past videos, what do I always say? Every investment is the present value of all future cash flow. And what you're trying to do is buy $1 of today's value for less than $1. So in essence, you're trying to buy $7.4 billion of today's value in Company A for less than $7.4 billion. You're trying to buy $12.9 billion in value for Company B for less than $12.9 billion. Don't get stuck on $1. Get stuck on what that $1 represents. It represents the value. In this situation, that is in Company A, it's $7.4 billion. That's the investment amount. You're trying to buy that investment for less than the actual return of that investment. Same with Company B. It's the exact same thing. In fact, so much that if you look at our world famous stock analyzer tool, the very first line of stock analyzer tool that you have to input is revenue growth. Guys, where in the stock analyzer tool do I even have the balance sheet? I don't even have a balance sheet on here. I have nothing about assets, nothing about liabilities, nothing about shareholder equity, nothing at all. I'm focused on the growth of the business and trying to buy that future value for less money. Now, what actually happens with emotion? Well, people go out there and say, oh my God, this company is so boring. It's only growing at 4%. Oh my God, this company is so exciting. It's growing at 15%. Guess what, guys? No matter what the stock price is, these are not going to change. The growth rate is based on the net income. The net income will be sitting there. So people will start selling the company A to buy company B. So what's going to happen to company A stock? What's going to happen to company B stock? At some point, usually people are discounting this way too much on company A and overpaying for company B. But remember, in the short run, stocks are a voting machine. But in the long run, they're a weighing machine. And in this example here, guys, I want to repeat, both investors here can make 10% return. Now, look how simple it becomes. Let's say you say, you know what, I'm not good with 10%. I want 12% in both companies. Guess how the prices change? Now, the price goes lower. Company A goes to 6.8 billion. Company B goes to 11.6. Why? Because you wanted a higher return. The lower price you pay, the better your return. The higher the price you pay, the worse your return. It's no different for either company. They still go up and down. Now, the proper argument to make might be, well, this is a boring company, but it's going to stick around for a long time. So I'm okay making 10%. And company B, yeah, growth is going to require a lot of debt. It's going to require a lot of, overhead, et cetera. Maybe I need a bigger return than this. So I need a 14% return. Now look at the company prices. Back to 7.4 billion on company A. And now company B is falling to 10.5 billion because you need a higher return. But if they were two companies where you sat there and said, I'm okay making 12% return, this is the price you have to pay for that present value of all future cash flows. I am making this simplistic for a reason, but it always makes me laugh when people say, I'm not a growth investor, I'm a value investor. I'm not a value investor, I'm a growth investor. It's like Warren Buffett and Charlie Munger always say, there's an investor, and every investor should be a value investor. They are the same words because the goal of investing is to sit there and buy an asset for a price that gives you safety as well as an adequate return on your money. And if the market for that asset goes away for 10 years, you still get some sort of return in the business. And that's where this comes in. That's why I don't consider cryptocurrency an asset, an investment. That's why I don't consider baseball cards an investment. That's why I don't consider art an investment. You're not getting some return outside of being able to sell it to somebody else at a future greater price for no other reason than supply and demand. Now, where it might get difficult is this. Fast-growing companies tend to be smaller than amazing companies. So let's go company A. Instead of $1 billion in profit, does $100 billion. And company B still does $1 billion. Now, here's where things get tricky. What will end up happening is people will not calculate the 11.6 billion here needed to make 12% return, and they'll pay 25 billion. Why? Because company A is so boring that the price is 680 billion. I'd rather pay 25 billion for this than 680 for this. So what happens to company A? What ends up happening is the price falls, and all of a sudden the returns, look, down to 500 billion, it's still absurd. It's still 20 times more than this one. But guess what? Now your potential return is 20%. So what I want to teach you on this channel is a process. This process can be applied to everything, buying a business in whole, investing in equities, investing in real estate. Go find the companies that people are not crowding around. Look at the hype surrounding all the companies of the last 5 or 6 years. Remember how Tesla was unstoppable for the longest time? Paul, you are stupid for not getting Tesla. It's a tech, they're still saying it's a tech company. And guess what? The stock is down 60% over the last 2.5, 3 years. Because eventually people realize, okay, who else is out there to buy this growth story? And guess what? Tesla keeps growing. It still has the amazing growth, but now things have stalled. Because in the long run, stocks are a weighing machine. In the long run, the true value of the company will come to the surface. Now, guys, the hardest part about all this is the emotional side of this. Seeing a company that has great returns potentially keep falling in price. And the emotional side of seeing a company that people are overpaying for keep going up in price, 25, 30, 35, $40 billion. That's difficult Being able to avoid that euphoria and that FOMO and also the fear of a price falling is the difficult part of investing. We can all do these Excel sheets. We can all understand the numbers. We all think Microsoft isn't going away. It's going to grow its free cash flow. It's going to grow its profit. But do you have the ability to sit there and when the stock is declining, look at it and say, the fundamentals are still the same, if not better. I need to stay in the stock. That's what makes investing hard. And that's exactly why I created the community of like-minded investors in our software. So if you want to be around like-minded people who can help you with the emotions and you can help them with the emotions, click the link below, sign up, $7 for 7 days, limited number of spots, so go sign up now. But the key here is for managing your emotions. We've all made bad emotional decisions in investing. Every single one of us, Warren Buffett, Peter Lynch, everybody. The smart ones are the ones who realize it and change their behavior. The smart ones are the ones who sit there and say, when you buy a stock, you're buying a piece of a business. You have to be able to let Mr. Market show you the price going like this, and you still continue to buy. That's difficult. And usually over the long run, it's the right thing to do. But being able to do it in the short run, when all the emotions are running rampant, that's very, very difficult. So make it easy on yourself. Sign up, click the link below. Now, for me personally, and this is what works for me, and I'm just here to teach you my process, and you can apply it any way you want. For me, I like to follow companies that people are overlooking because the price stays lower and you can get more value. Cash is king. And a company that's been around for a long time, generating a lot of cash that keeps growing, even though it's small, you can get such great deals that to find the big growth in company B is very, very difficult. Don't get me wrong. I have company B stocks. I have companies that are small that have a lot of growth potential. But usually those are companies who are overlooked for some issue. That's the hard part about investing. That is what makes investing difficult. If it was just about buying a company and saying, buy the company, blah, blah, it would be awesome. And there is a way to do that. It's called dollar cost averaging and low cost ETFs. But if you want to pick individual companies, I want you to first understand that every investment is the present value of all future cash flow, and growth and value investing are the same thing. But remember, not all value investing is growth investing. There is a way to buy companies that have a lot of assets and very little business left. I used to want to do that. I no longer want to do that. I'd rather buy companies and ride them out to the future sunset because they're great at driving up cash flow, buying back cheap shares, and properly allocating their money. So if you want to see some of those 33 companies that I either own or I'm looking to buy, watch this next video. Thank you for your time.